A retirement rule hidden inside many 401k and traditional IRA accounts can quietly create a major tax problem later in life if it is ignored, and that rule is called the Required Minimum Distribution, or RMD. It may sound like a small technical detail, but it determines when tax-deferred savings must finally be withdrawn and taxed. The danger is not the retirement account itself. The real danger is waiting too long to understand how required withdrawals can affect taxable income, Social Security taxation, and future retirement cash flow. Traditional retirement accounts allow people to save money over decades while delaying taxes on investment growth. That delay is valuable because the money can continue compounding without annual taxation. But tax deferral does not last forever. At a certain age, the IRS requires withdrawals, and those withdrawals become taxable income. That is why many financial experts describe RMDs as a retirement tax bomb. The phrase is not meant to create fear. It simply reflects the reality that large tax-deferred balances can eventually create large taxable income. An RMD is the minimum amount the government requires someone to withdraw from certain retirement accounts after reaching the applicable starting age. The word required matters because these withdrawals are not optional once the rule applies. For years, many retirees believed age 70 and a half was the starting point. Later, the age changed to 72, and after the Secure 2.0 Act, the rules changed again. Under the framework discussed here, people born before 1960 begin RMDs at age 73, while people born in 1960 or later begin at age 75. That timeline matters because missing an RMD can trigger a serious IRS penalty. The penalty discussed here is 25% of the amount that should have been withdrawn but was not. Even though the penalty used to be 50%, a 25% penalty is still painful. Imagine a retiree with a $1 million IRA. Based on IRS tables, the required withdrawal for a year might be around $42,000. If that withdrawal is missed, the IRS could impose a 25% penalty on the missed amount. That would equal $2,500, and that is before ordinary income taxes on the distribution are even considered. One missed deadline could therefore cost more than $10,000 in penalties for a single year. The important point is that this outcome is avoidable with proper planning. Once someone understands the rule, the next step is reducing the future tax pressure before forced withdrawals become overwhelming. RMDs can increase taxable income, potentially push retirees into higher tax brackets, and even cause more Social Security benefits to become taxable. That combination can create a painful chain reaction. One major strategy for reducing future RMD pressure is the Roth conversion. Instead of waiting for the government to force money out later, a retiree voluntarily converts part of a traditional IRA into a Roth IRA and pays taxes on the converted amount earlier. The goal is not to eliminate taxes entirely. The goal is to control when the taxes are paid. Early retirement years can create an especially valuable planning window because employment income may have stopped while Social Security and RMDs may not have started yet. During those years, some retirees can strategically convert portions of a traditional IRA while remaining inside lower tax brackets. Once money is inside a Roth IRA, it can grow tax-free, and Roth IRAs do not require RMDs for the original owner. By reducing the size of the traditional IRA before required distributions begin, retirees may reduce future RMD amounts and gain more control over taxable income later in life. Another valuable strategy for charitably inclined retirees is the Qualified Charitable Distribution, commonly called a QCD. This allows IRA money to go directly to a qualified charity while still satisfying the RMD requirement. The process matters because the funds must move directly from the IRA custodian to the charity. If the same $42,000 RMD is withdrawn normally, it increases taxable income by $42,000. But if that $42,000 is sent directly to a qualified charity through a QCD, the retiree can satisfy the RMD while adding zero taxable income from that distribution. For people who already intend to support charitable causes, this can be a powerful strategy because it satisfies the IRS requirement while limiting taxable income. The broader lesson is that RMD planning should never be treated as a last-minute issue. Retirement accounts represent decades of work, sacrifice, and disciplined saving. But protecting that money requires more than simply growing the balance. It also requires understanding how and when the money will be taxed. A strong retirement plan should include estimating future RMDs, looking at Social Security, pensions, rental income, and other sources of income, and understanding how all those pieces interact inside the tax system. The key takeaway is simple. Tax deferral is powerful, but it is not tax elimination. Required withdrawals are predictable, but they are not optional. Penalties can be severe, but they are avoidable when the rules are understood early. People born before 1960 begin RMDs at age 73, while those born in 1960 or later begin at age 75. Missing a required withdrawal can trigger a 25% penalty, even though the penalty used to be 50%. A $1 million IRA may require a withdrawal around $42,000, and missing that withdrawal could create a $2,500 penalty. Roth conversions and QCDs can help reduce future tax pressure, but timing and strategy matter. In the end, the real goal is not simply avoiding penalties. The goal is keeping more control over retirement income, taxation, and long-term financial stability before the IRS timeline begins making those decisions instead. What stands out most is that many retirees focus only on building the account balance during their working years and spend very little time thinking about the withdrawal phase until it is close. Yet retirement planning changes dramatically once required distributions enter the picture. A traditional IRA or 401k may look like a pool of savings, but much of that balance may still be waiting to be taxed in the future. That is why understanding the timing of withdrawals matters so much. A retiree who plans several years ahead may have far more flexibility than someone who waits until the first mandatory withdrawal deadline arrives. This is where careful income mapping becomes important. Looking at Social Security, pension payments, rental income, and future RMDs together can reveal whether future taxable income may become uncomfortably high. For some retirees, future RMDs may be manageable without major changes. For others, the combination of Social Security and forced withdrawals could create a significantly larger tax burden than expected. That is why strategies such as Roth conversions are often viewed as long-term planning tools rather than short-term reactions. They allow retirees to shift part of the tax burden into years where income may be lower and tax brackets may be more favorable. The same logic applies to QCDs for retirees who already intend to donate to charity. Instead of increasing taxable income through a normal withdrawal, the retiree may satisfy the RMD requirement while supporting causes they care about. Another important detail is that RMDs do not only matter in the first year they begin. Once required distributions start, they become part of the annual rhythm of retirement. That means one missed deadline or one misunderstanding can affect multiple years if the issue is not corrected quickly. The smartest approach is to treat the RMD age as a serious planning checkpoint instead of a minor technicality. Someone with a large retirement account may have spent decades carefully saving and investing, and protecting that wealth requires understanding not only how the account grows, but also how the money eventually leaves the account. The people who usually handle this transition best are the ones who prepare early, estimate future withdrawals, study the possible tax impact, and build a system that prevents missed deadlines. They understand that tax deferral helped build the account, but they also recognize that the IRS eventually expects distributions and taxation. They know the difference between reacting late and planning early can be measured in thousands of dollars. That is why RMDs deserve attention long before the first withdrawal becomes mandatory. Here is where the story becomes even more important for retirement planning. Many people assume that because they do not need the money, they can simply leave it inside the account forever. That assumption can create problems because the IRS rules do not depend on whether the retiree personally needs the income. Once the required age arrives, the withdrawal requirement begins regardless of spending needs. This is why retirees who ignore the issue sometimes discover too late that they have lost control over the timing of taxable income. The larger the traditional IRA or 401k balance becomes, the larger future RMDs may also become, especially if the investments continue growing over time. That can create a situation where successful long-term saving actually produces higher taxable income later in retirement. Understanding this possibility years in advance gives retirees more opportunities to respond strategically instead of emotionally. Some may decide to spread Roth conversions across several years. Others may decide to coordinate withdrawals carefully with Social Security claiming strategies or pension income. Some may use charitable giving through QCDs as part of a broader retirement income plan. The important point is not that every retiree should follow the same path. The important point is that every retiree with tax-deferred savings should understand the rule well enough to make intentional choices. Another reason RMDs matter is because taxable income can affect more than federal income taxes alone. Higher income can sometimes influence the taxation of Social Security benefits and may affect other parts of retirement cash flow planning as well. That is why retirees often describe forced withdrawals as frustrating, even when they do not need the extra money for daily spending. The withdrawals can change the entire tax picture. The most effective response is preparation. Know the correct starting age, know the estimated withdrawal amount. Understand that the penalty for missing an RMD is 25%, even though it was previously 50%. Recognize that a $1 million IRA may create an annual withdrawal around $42,000 and that missing it could trigger a $10,500 penalty. Most importantly, recognize that retirement tax planning is not only about growing wealth, it is also about managing how wealth is withdrawn and taxed over time. The retirees who stay ahead of these rules usually avoid unnecessary penalties, maintain greater control over their income, and reduce the risk of being surprised by avoidable tax problems later in life.